Are you interested in getting started with investing, but you feel intimidated and don't know where to begin? Investing can be one of the most complex concepts in personal finance, and it can be very jargon heavy. There's so many different investment options like stocks, bonds, crypto, real estate, foreign exchange, or even collectibles like Beanie Babies. In today's video, I'm going to break down investing into simple terms and guide you through everything you need to know to start investing as a complete beginner. I will also invest $2,000 of my own money and show you a beginner strategy you can use step by step. Let's get started. Investing is important because it is a key cornerstone to wealth building. When investing properly, you can generate passive income while you sleep. That means instead of working to trade your time for money, you put money to work on your behalf. Investing also helps to beat inflation. Inflation is the rise in the price of goods and services. This McDonald's in Lakewood, California is the oldest McDonald's in the world. When it opened its door in 1953, a hamburger cost 15 cents. Today, it is $2.79. That is inflation in action. Prices for everyday goods like milk, eggs, and bread have also increased year after year. On average, the annual inflation rate is 2 to 3%. But in 2022, inflation went as high as 8%. If you simply capture cash under the mattress, inflation will reduce the purchasing power of that cash. It eats away at your savings, and that's why investing is so important, not only to keep up with inflation, but also to preserve and build your wealth over time. And what's the best time to start? You're never too old or too young to start investing. The earlier you start putting your money to work, that money can begin to accumulate more rapidly at an exponential rate, thanks to the power of compound interest. Compound interest is what happens when the interest you earn on the savings starts to earn interest on itself. Think of it like rabbit breeding. Those cute little bunnies make more little bunnies, and those more little bunnies make even more baby bunnies, and before you know it, you have a forest full of bunnies. Of course, money doesn't grow as fast as bunnies, but you get the idea. Before you start on the investment journey, make sure you have these 3 financial basics squared away. First, make sure you have put away 3 to 5 months of emergency fund. So you have a buffer for unexpected events like a sudden medical procedure or a loss of income. That way, you're able to recover quicker and get back on track toward your savings goal. And put this money in a liquid account like a high-interest savings account that does not charge any fees. Second, pay off all of your high-interest consumer debts. Personally, I consider high-interest debt as anything above 10% interest. It could be anything from personal loans to credit card debts. It's shocking to see that the average credit card interest today is 24%, and it's nearly impossible to find investments that will give you the return to match a 10 to 24% interest. The stock market on average returns around 8 to 10%, so whatever you make in the stock market will be canceled out completely by high interest debt. So mathematically, it makes a lot more sense to eliminate all high interest debts before you start investing. Third, only invest money you can afford to lose or don't need to use in the near future. Savings and investings are not the same. Savings typically means zero risk with lower return, whereas investing allows you the opportunity to earn a higher return, but you do take on the risk of loss in order to do so. Let's say if you plan on using that money as a down payment for a house within 1 or 2 years, then it's best to keep it in a high-yield savings account. Because the stock market fluctuates up and down, and you don't want to sell your investment at a loss just because you need the cash. Investing requires a long time horizon that will allow you to ride through the market's ups and downs. According to Money.com, if you hold out for 5 years, odds of losing money in a stock market are slim. If you can wait for 20 years, they're all but none. So where should you put your money? There's so many different options to choose from, and it takes time to understand the different asset classes. Investing in the stock market is the most common strategy, and if done properly, it provides predictable returns over a long period of time, like 10 years or longer. Stocks are shares of publicly held companies like Starbucks and Netflix. When you buy a company's stock, you're buying a tiny fraction of that company. However, To properly invest in individual stocks, you need to first invest the time and a lot of attention to learn some important metrics about each company. Price of individual stocks can be very volatile, and there's also the risk if the company goes belly up. Picking the right stock can be challenging, and even professionals whose full-time job is to analyze markets and companies, they can't get it right a lot of times. As a new investor, you may not have the time or resources to actively manage your own stock picking. So the most ideal strategy is to stick with an index fund that mirror the stock market and track the performance of benchmark indexes such as the S&P 500 or the NASDAQ 100. First, let's clarify what an index is. Index tracks the stock price of a group of companies. For example, the S&P 500 index tracks the market capitalization of 500 largest US companies, including all of the names you are familiar with, such as Apple, Walmart, Coca-Cola, and Amazon. You cannot invest directly in an index because it's just information that's gathered. However, you can invest in a fund that replicates the performance of that index. I will show you how to do that in a little bit. Here is a breakdown of the 500 companies tracked in the S&P 500. These companies are selected from 11 different sectors, from financials, industrials, to healthcare. When you buy one share of the S&P 500 index fund, you buy a fraction of all of the 500 companies. This way, you minimize risk by diversifying your investment into 500 companies. If one company happens to have a bad year, your overall portfolio will be okay. This chart here shows the S&P 500 annual returns since 1930. Some years, the S&P 500 had negative returns, but as you can see, there are more positive years than negative years. SoFi.com calculated the annual return of the S&P 500. Within the recent 5-year period, the average annual return is 11.33%, and it's 12.39% for the recent 10-year period, 9.75% for the past 20 years, and 9.9% for the last 30 years. And these data included the heavy market downturn in 2022, the 2008 financial crisis, and the dot-com crash of the 2000. If you bought at the peak in 2007, right before the financial crisis, and sold 2 years later in 2009, you would have lost money. But if you held on to that investment until 2013, you would have broken even and continued to double and triple by now. So the proper investment mindset is to have a long time horizon. That way, you can ride through the market's ups and downs and come out ahead. The best part is, you don't need to actively manage or study each company. Investing in indexes is a passive way to make your money grow in your sleep. Another popular index is the NASDAQ 100. It is a basket of stocks consist of the 100 leading companies, which focuses more heavily on the technology stocks. The NASDAQ 100 outperforms the S&P 500 by a wide margin, but it also comes with more volatilities and risk. On average, the NASDAQ 100 returns between 11% to 17.3%. And how do you buy index funds? There are 2 ways to do it, either a mutual fund or an exchange-traded fund. Both can be purchased with any major online brokerage like Charles Schwab, Fidelity, and Vanguard. All index mutual funds and the vast majority of ETFs use the same strategy of passive index investing. The difference is how they trade. ETFs trade like stocks, and they're bought and sold whenever markets are open. The price fluctuates throughout the trading day, whereas shares of mutual funds are purchased only once a day after the markets close. The price is calculated at the end of each trading day, so technically, when you submit a buy or sell order for a share of mutual fund, you won't know the actual price until after the market close. An important thing to know is that there may be investment minimums for mutual funds, depending on who you open your accounts with. Fidelity and Charles Schwab have no minimum requirements on initial investments. Vanguard, on the other hand, requires a minimum of $3,000 initial investments. And as for ETFs, there are no minimums on initial investment. Another thing to look for is the expense ratio. Even though index funds are passively managed, there are fees in the form of expense ratio to cover administrative and other operating expenses. Expense ratio is a percentage of what you will pay on top of your gains or losses. And there are many index funds to choose from, and here are some of the common funds. Each fund and ETF is assigned and identified by a unique ticker symbol. For mutual funds that mirror the S&P 500, there's the Fidelity 500 Index Fund with ticker symbol FXAIX. The expense ratio is 0.015%. The Vanguard 500 Index Fund Admiral Shares VFIAX has an expense ratio of 0.04%. And the Charles Schwab S&P 500 Index Fund SWPPX has an expense ratio of 0.02%. A common mutual fund that mirrors the NASDAQ 100 is the Victory NASDAQ 100 Index Fund, USNQX, with a 0.45% expense ratio. And for ETFs, the Spider S&P 500, SPY, is the most commonly traded ETF, with the expense ratio of 0.09%. You also have the Vanguard 500 Index Fund ETF, VOO, with much lower expense ratio of 0.03%. Invesco QQQ Trust ETF has the expense ratio of 0.2%. This is how the expense ratio works. Let's use the example of QQQ. If you make 10% gain on QQQ, you actually make 9.8%. And if you lost 5% on your QQQ investment, you actually lost 5.2%. One thing to know is that if you decide to invest in index funds through mutual fund, it's best to buy the index fund owned by the same brokerage. You can certainly buy a Fidelity fund through Charles Schwab, but Charles Schwab would charge a higher transaction fee. So if you want to invest in a Fidelity S&P 500 fund, then set up the brokerage with Fidelity. And as for ETFs, it doesn't matter which brokerage you choose because they're more or less the same. So pick a brokerage, go through the process of creating an account, and link your bank account for fund transfer. Once the money is in your account, you're ready to invest. There are different types of brokerage accounts, like the employer-matched retirement account or the Roth IRA. To learn more about the different account options, watch my video here discussing different retirement accounts. Now you have some basic knowledge on index fund investing. Let's go through some live examples together. I already have my brokerage set up with Charles Schwab. First, I will show you how to buy S&P 500 index through a mutual fund. To buy a Schwab S&P 500 index fund, go to Trade, select Mutual Funds. For symbol, enter SWPPX. Under Action, select Buy. To buy mutual funds, you enter the dollar amount instead of number of shares. Here, we will enter $1,000. You also have the option to reinvest the dividends and capital gains. Select to reinvest both. That way, there's more money putting to work with compound interest. Then click Review Order. Make sure you enter the correct information and click Place Order. Next example, I will show you how to buy the S&P 500 Index Fund through ETF. Go to Trade and select Stocks and ETF. Under Symbol, we can enter either VOO or SPY. You can see the price of each one. And even though they're nearly identical investments, the difference in price is due to the fund's management. SPY is more popular with active traders because of its liquidity and smaller bid-ask spread. However, for passive or long-term investors, VOO is a better option due to the lower expense ratio. Because the market is currently open, we can see the bid and ask price of the share. Bid price is the highest price a buyer will pay to buy at any given time. Ask price is the lowest price a seller will sell the stock. Under Action, select Buy. As for quantity, the number here is for the number of shares. Charles Schwab allows for fractional shares only on stocks, but not on ETF, so we have to buy in whole shares. We can use the calculator to figure out how many shares to buy with our budget. For $1,000, we can buy 2 whole shares of VOO. Then hit Apply. Click on Reinvest Dividends to allow compound interest to work. A market order is to buy or sell the security immediately at the current price. A limit order is to buy or sell only at the price you specified. The order will only go through if the share is trading at that specified price. For the sake of this video, we will place a market order to buy at the current price. Under Timing, select Day. This means the order is active for 1 day only. Then click Review Order and make sure you have entered the correct information. Then click Place Order. And that's it for this investing tutorial for beginners. I hope this video has addressed your fears of investing by showing you step-by-step process of how to do so. Financial literacy is so important, but it's not taught in school. We're left on our own to figure it out, and that's why I want to make these videos and share my lessons learned. If you find this video helpful, please share it with someone who could benefit, and don't forget to like and subscribe. See you in my next video.